Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to this episode of Provident's Healthcare Dealcast. We have Eric Major, Justin Hand, and AJ Shekar joining. The topic for today's discussion is around the transition from an independent practice of medicine for practice management organizations to private equity-backed ownership structure. For many practice management organizations, there are a number of considerations from the shareholders of these businesses and also the employees of these businesses that can influence whether or not the timing is right for a private equity deal and also what life looks like post-transaction. These businesses are very different than, other businesses, not only within healthcare services, but also in the broader economy, in that the assets of the businesses are generally the providers, and the success of an overall PE investment is highly dependent on ensuring alignment between providers, minimizing turnover, and really maximizing the retention of the key producers and assets within the business. So in order to create kind of a smooth transition, it's important to keep in mind various elements, which we'll comment on throughout this podcast. I think just as a starting point, it would be helpful to provide a bit of an overview and refresher on the private equity model for those who haven't been familiar with it or listened to our previous podcasts. Private equity is essentially a investment vehicle for investors, whether they be wealthy individuals, institutional investors, larger kind of financial institutions to invest into the private markets, hence private equity in nature. The goals of these transactions are to essentially increase the value of investment for the constituent parties under the private equity funds umbrella, but also structure the transaction in a way to maximize long-term value for not only the company shareholders, but also the private equity firm. There are a number of different deal structures under the private equity model, whether that's a majority acquisition of equity in the business or a minority acquisition of equity in the business. But the common themes are to take the value of equity at the time of investment from both parties and increase that over a, call it 5 to 7 year time horizon prior to a subsequent exit for the entire shareholder base to either a larger private equity firm or a strategic acquirer, or in certain circumstances to go public with the investment. So there are, I think, a number of differences in terms of how the private equity approach differs from the independent practice of kind of medicine, and also the way that practice management organizations in particular think about the value of their businesses. And I think that the first is, really around the value of distributions from a practice as a shareholder versus kind of the inherent equity value within that business.
Yeah, and I'd say one of the most important shifts that happens within a private equity deal in order to really create the proceeds and valuation of a business, private equity firms typically are paying a multiple of the cash flow of the business, which would require most typically an adjustment to the compensation of the providers, or at least the owning providers, not the employed providers. And I think that this concept is very difficult for providers to understand, but really it becomes an education on the value of equity within a physician practice or a practice management company. Most groups, have developed their businesses with buy-ins and buyouts that really are pennies on the dollar to what an independent investor would value the business. And part of these transactions, private equity firms are really creating aligned incentives through having everyone, share ownership within the same common entity post-closing, with the goal of growing the value of that entity through, additional growth and acquisitions.
Yes, I think private equity in a lot of ways has become a really positive alternative to what has historically been an exit for a shareholder within a practice management group, in particular in the physician world, has been selling their equity to the younger generation that was going to be stepping into their shoes in terms of practicing medicine, or an alignment with the hospital system, which typically is against the rationale as to why an individual join private practice. So over about the last decade, we've seen a real big concentration of investors moving into the sector and trying to find ways in which you can empower physicians to be more productive by centralizing a lot of the back office functionality of these practices and getting physicians or providers back to seeing patients in a way that they feel is more productive and ultimately is more enjoyable in most instances for the providers themselves. So what private equity has really been able to provide for these private practices is the evolution from a small localized organization into, in many instances, large-scale, multi-state, or in many instances, even national providers of practice management services through the vehicle of capital that's been invested and put into these organizations to support the growth of the organization. And so what has been really interesting for us and been a real driver of our firm and many firms' successes over the last half decade has been this confluence of private equity dollars flowing into practice management transactions. And so the profile of our organizations that we're representing have really been changed from smaller practices that typically would be aligning with hospital systems, or that's really the extent of where they were going with organizations, into creating real companies and organizations that are supported by capital, industry expertise, that provide access to relationships, access to payers, that can really help transform these practices into much larger, in many instances, multi-state or national providers of services.
And I think really the goal with all of these growth initiatives is to allow these physicians and other providers to tap into the equity value of their businesses. So in the past, really, that wasn't a consideration for groups as they're trying to maximize distributions. With these private equity deals, there's inherent equity value in these organizations that can be enhanced through growth and through centralizing services and through expanding into new markets. And really, private equity provides that opportunity to tap into that growth. I think what's important with the structures that we're seeing within the vast majority of our transactions, these aren't 100% buyouts. You might have heard of those case studies in the 1990s with buyouts being more of a common structure. I think buyouts could work in the short term, as physicians end up getting a lump sum payment and they're working for market rate compensation. But if you think about the longer term sustainability of that model, equity is really the key there. You need the physicians to not only have some cash at closing, but also meaningful ownership post-closing and market rate compensation to keep this model working in the long term.
And I think just piggybacking on that point, I think the model previously for a lot of practice management organizations was to create that sense of ownership for distribution purposes, and therefore creating engaged and motivated, providers within their given practices. And I think what has made private equity investment successful in a number of instances in practice management is that the private equity firms are taking that similar element of, trying to create that broad-based ownership structure, except shifting the focus from the distribution to the equity side of things. And I think what has made practice management companies successful in a number of verticals has been to align those incentives across, the broadest pool of producers within these businesses. So in several of our kind of previous clients' cases, it's not only just the existing shareholder group that is able to get the benefit of kind of cash at close, but also the equity rollover equity component and ownership with private equity in the given organization, but also offering the option for key producers to become shareholders over time, such that everyone's interests are aligned towards retention, keeping productivity within the business, but also making business decisions that will help create equity value long-term, whether that's investing into scalable infrastructure, onboarding new acquisitions or potential new hires that can help increase the value of the business, but also kind of stretching that to the back office side of things, where under private equity models, it's important to have kind of talented management that's able to help navigate the growth of the business, especially when you're thinking about increasing the size of an organization significantly over a relatively short period of time of, call it 3 to 7 years for most private equity investments. And so, the opportunity is there under the private equity model as well to reward, a talented CEO, talented COO, or even a chief business development officer that might be responsible for add-on acquisitions and de novo growth initiatives to also participate alongside the provider shareholders and the private equity group in the ultimate success of the business venture here.
So when we talk about equity for a practice, I think we're focusing more on just ownership across the entire shareholder organization. What we've seen in our deals is that the transaction can look different shareholder by shareholder depending on where each is, in their individual careers. If you look at transaction structures around this issue, there's many different ways to look at this. Obviously, it taps into, some legal items that need to be negotiated and also tax implications as well. But a common theme that we'll hear is there's certain shareholders that might be within 5 years of retirement, and there's other shareholders that could have just become partners within the last year. And how do you make a transaction work for shareholders at each of those stages of the careers and everyone else in between? And I think the most common structures we see, typically revolve around looking at varying levels of rollover equity. Justin, if you want to touch on that.
Yeah, absolutely. One of the comments that AJ made earlier was when you think about private equity, we tend to think about it as an investment vehicle. But the reality is what they're trying to come up with is an investment partnership so that all members of those that are going to be producing within the organization are helping drive success. So that starts with management, as just described. So allowing your CEO or your CFO and others within the C-suite to participate in the organization helps with the predictability of the future, but also ensuring that you structure a deal that satisfies both those that are closer to retirement through a payout, but also aligning incentives for your youngest generation of physicians, shareholders that have recently become shareholders. And we'll get into those that are on track to become shareholders in a little bit, but you can come up with a lot of creativity in terms of how you structure these buyouts for the variations in the longevity of those that are going to be participating in ownership on a go-forward basis. So as Eric alluded to, you always need to ensure that you're thoughtful around the tax consequences of creativity in these structures, but different ways in which groups have satisfied or dealt with the variations in longevity of practicing going forward has been perhaps you have different levels of vesting schedule on the equity post-transaction. So if there's a rollover or another way to think about that, if what you retain from an ownership perspective is, say, 20% on an individual basis, some groups may allow that to invest immediately. Some will allow that to vest over 2 or 3 years, or some collectively will make the decision that there's a rationale for having that vesting schedule last 4 years. A lot of times, or most instances, that is the original founders or original shareholders or board of the organization that's helping determine what is the right structure to ensure that we've got predictability in terms of the partners still participating and practicing at a similar level post-transaction as they did before. Another way that we've seen kind of dealing with the variations in terms of longevity of post-transaction is how you allocate proceeds. And so you typically can think about, again, it's at the discretion of the board or the original shareholders with kind of the sign-off of private equity, but you typically can think about how you allocate proceeds based off of foregone compensation. That doesn't always tie into age or necessarily the demographics of the group, but we will typically see that proceeds are distributed based or can be distributed if it's done in a tax-effective manner and based off of the structure of the organization, can be done based off of what you forego on an individual basis. But what you need to solve for is that if your highest producer or some of your highest producers are at the back end of their careers and anticipating to retire in, say, the next 24 months post-transaction, then you really need to be thoughtful around the equity component. And perhaps you should, or a way to solve to ensure that those individuals just simply don't take their cash or their proceeds and retire without letting the group know. Perhaps there's an instance where you insist or you ask those individuals to roll over more than 20% in that example that I gave earlier, and you would ask them to roll over 35 or 40% ownership. And none of these percentages or structures are set in stone. every deal has to be structured in a very different way, even within the same subspecialty. You can think about a dermatology practice. There's no single dermatology transaction that's structured in the same way because geography can make an effect based off of your payer environment. Your specialization within a dermatology practice can vary greatly between Mohs and general dermatology versus cosmetic. So you have to have a lot of flexibility in terms of how you structure these transactions based off the longevity of those individuals that are current shareholders in the organization.
And I think one of the secondary considerations too is obviously if you reinvest more equity in the initial deal, I think there's more upside opportunity for the providers that do so. And as we've seen in other industries that have been consolidated more heavily over the last decade or so, such as the dental sector, with groups typically exiting to larger private equity firms, there's an opportunity to go through multiple different transactions if you're a younger partner. And that's really where the rollover equity in this initial deal becomes a more longer term decision, because if you leave more within the business today, then there's opportunity for returns that are above where you can invest that money if you took it out in cash and invested into the stock market or into other investment vehicles.
As Eric had alluded to, when you think about the younger generation or the youngest shareholders within these organizations or youngest providers within these organizations, they typically can experience multiple liquidity events because private equity firms are most likely to exit their investment to larger private equity firms in, say, 2025, assuming the deal happened in 2020. And so as a young provider in these organizations that are existing shareholders, oftentimes you see them being really optimistic about the future and wanting to participate on that upside on the equity value, as we described before. Most important difference between historically thinking about it as a distribution model, an equity model in which the appreciation and the value of those shares as they continue to practice medicine or within their existing organization allows them to participate on the upside on this value. In some instances in our clients, they're on their third equity event and they've had payouts in each of those equity events and individually can elect to roll over proceeds in each of those respective future equity events.
Yeah, and I think it also creates kind of a differentiated recruiting pitch for groups that are backed by private equity versus independent practices, in that the new providers coming online have the opportunity to buy in as shareholders to this business and receive significant kind of wealth creation events down the road as a result of, an exit process to a larger private equity firm and subsequent recapitalizations down the road. And I think overall it's important, and it's something that has been a focal point for the private equity firms investing into practice management about identifying kind of those key individuals in the business that might be employees or potentially shareholder track providers, and making sure that they're similarly, taken care of as part of a transaction, because the last thing any private equity firm partnering with a practice management organization would want is to undergo a transaction and then have, a group of unhappy providers that may have not gotten an opportunity to become shareholders or receive something out of the transaction as the older or kind of more tenured individuals within the organization did. So I think key considerations to keep in mind for groups that are thinking about going through a transaction process and have individuals that are either currently employed and been offered shareholder path moving forward, or simply kind of important producers within the business that haven't been offered partnership but would be key to the ongoing success of the venture going forward, would be to think about how best to potentially either vest those individuals with equity over time, whether that's kind of providing them stock in this new organization in concert with the private equity firm, or potentially staging proceeds to those individuals over time in order to make sure that there is, that incentive for them to continue producing the way that they had pre-transaction and staying with kind of the overall business and direction over the next few years.
Yeah, with the theme that we've been discussing of incentives, I think, as AJ mentioned earlier, Another theme that we see on our transactions is, typically for a platform deal, so a deal where a private equity firm is making its first investment within a certain sector, they'll typically create what's known as an option pool or an incentive equity plan. And not only is that for some of the superstar physicians within the group, but it's also for current and future management team members. So if there's a CEO and a COO that have been critical to getting the practice to its position in the market today, and certainly will be critical going forward, the private equity firm's thought process is they're willing to dilute some of their ownership in order to offer incentives for these management team members to continue to drive growth post-closing. Because ultimately, there might be one or two providers that ends up taking on more of a CMO or a management type role within the business post-closing, but the vast majority of the providers will continue to practice as they were pre-closing and certainly don't have the time to be committing to meeting with potential acquisition targets or focusing on a new de novo facility build out or going out and getting, a license for a new ambulatory surgery center. The people that are driving that growth really starts with the management team members, and that's why the private equity firms provide this option for incentive equity. It could be based on time and or performance, based on the overall return on the invested capital that the investment delivers to both the private equity firm and the other partners. And it can be a very meaningful piece of the business, up to 10, 15% of the overall company. Obviously, very incentivizing for the management team members and also for potential new hires that AJ mentioned earlier, such as someone on the business development side, people that will be involved in M&A that could be potential hires and could have ownership through this equity pool.
So as we've talked about existing shareholders participating in this partnership post-transaction, and that being expected from these private equity firms to ensure the consistency of practicing providers. We've talked about management, which oftentimes don't participate in equity today, participating in equity tomorrow under these new partnership relationships. How we break out the last two segments are, how do we deal with individuals that are currently working for an organization in an associate or on a partnership track, or how do we deal with recruitment of physicians in a post-transaction world with private equity? Obviously, these 2 points are some of the most critical areas that we discuss, and fortunately, it's typically the number one question that we get from groups when we actually sit down and meet with them starting to talk about private equity, which is encouraging because that means that shareholders can appreciate the value of having a predictable income stream in a post-private equity world. And typically every group, when you think about the first bucket, which are associate track physicians that are already a part of the organization and contributing towards the income and the production of the practice, every group elects to deal with those in a different way. So you can take the two vast extremes, which are, we have clients of ours that the board of directors of the selling organization or the group that's receiving funding elects to treat those associate track physicians as though they were already a shareholder within the organization when they transact or when the company transact, meaning that if Eric was due to become a shareholder in our organization in 2020 and our firm elected to transact, that we would effectively accelerate him as a partner and he would be participating in a transaction in 2020 when our organization did a deal, less whatever buy-in he was expected to pay, assuming no transaction. And I'd say that that's an extreme, but it happens on occasion. The alternative is we have organizations that say, unfortunately, you weren't here when we elected to transact, and therefore we're not going to treat you as a partner, but you will be expected and invited to participate in a stock option pool, which will allow for you to participate in the benefit of the appreciation in the equity as we transact in 2020, to stick with that example. You will become a partner at that point, either through a very nominal investment, typically very different than the current buy-in on these practice management transactions, or perhaps it's just tied towards performance or time, and you will participate in the value appreciation from 2020 to, stick with that example we talked about earlier, 2025 when the private equity firm exits. Two vast extremes, and there's a lot of different variations of what is done in between, and we'll give a couple examples in a moment. But at the end of the day, the number one thing that everyone needs to be considerate of is you have to solve for those physicians that were joining your practice with the assumption that they were going to be participating in distributions on a go-forward basis. You have to solve to ensure that those individuals are satisfied with the structure of what they're getting out of the transaction today, and also how they participate in the structure in the future. One thing that we are always grappling with is, at what point in a process do you start to think about education of these associate track physicians? And again, we also see that done in two very different ways. Some of our clients will elect to invite the associate tracks to participate in all management meetings and decisions, beginning with starting a process and exploring an investment from private equity, because they feel as though transparency is how they've always managed their organization. And therefore, with this being the largest decision that has been made, why would you exclude the future generation of these groups? The alternative is some organizations elect not to share this information until the very end of a transaction. We feel as though somewhere in the middle is the right time to introduce this concept to associate track physicians that are already contributing to the organization.
Just like Justin mentioned about the current associate track physicians participating in a deal through stock options or a buy-in post-close, most private equity-backed practice management organizations also think about the value of equity as a recruiting pitch for new hires that they're bringing on board. I think that a key component to that is first identifying those hires that are important to the business from a clinical standpoint and making sure they meet the standards of the business overall. But I think second, also offering the opportunity for those new hires to potentially purchase equity in the business for a nominal sort of rate, like Justin mentioned, for the current associates within the business, but also having that ability to see value at a secondary liquidity event alongside the existing shareholders of the business, especially in the case where a group is kind of rapidly hiring in order to facilitate its growth objectives. That new youngest generation tends to have a lot of the growth kind of responsible on their backs on a go-forward basis. So private equity firms and, or the original shareholders of these businesses want to make sure that they are aligned from an interest standpoint to maximize that value of equity down the road. So while kind of the traditional recruiting pitch for independent practice management organizations that aren't backed by private equity is to potentially buy in and have the ability to get distributions over time, the kind of new recruiting pitch for private equity backed organizations is to show the value of the rollover equity they would be buying into or vesting into through a stock option pool, and what that means in, call it, a 3 to 4 year horizon when the group collectively decides to exit, or even kind of subsequently beyond that to the second private equity transaction and the third private equity transaction from there.
Yeah, all good points, AJ. And the one thing I'll add is obviously we're talking about concepts that are very new and are quite frankly high level compared to the amount of detail that you go into on these transactions. While this can be daunting as you start to hear about, recruiting with stock options and removing distributions from the compensation of owners, obviously it's a concept that's very complicated and involves a number of factors, both on the legal side as well as the tax side. And, I think part of our job is obviously working with groups and trying to come up with a structure ahead of going to market, understanding that this structure can be tweaked as we talk with individual investors. And the common takeaway, I would say, from a transaction is that no two are the same, as Justin mentioned earlier. Every deal, there's different nuances to work through in terms of specific shareholder dynamics, specific shareholders that are maybe unique in terms of their tenure with the company or their position post-closing, and how does their compensation and equity look. Every deal we have to work through these dynamics, both at the company level, but also drilling down to the individual level as well. And in summary, I think we talked about in this podcast really a few different concepts that center around how do you align incentives with a private equity firm in a post-transaction setting. And really the key theme throughout here has been utilizing equity or ownership within the business and the value of that to incentivize both current physicians and shareholders within the business, future and current management team members through incentive equity pools, and partnership track physicians, as well as new recruits that have the opportunity to obtain ownership either through profit interests or in stock options or through a traditional buy-in within a growing entity that's built for a subsequent transaction.
So thanks again for everybody joining this podcast here today and listening in. If you have any questions or comments about our recording here, please feel free to reach out to us at podcasts@providenthp.com. We welcome your feedback and any thoughts on other podcast topics that might be interesting or helpful to you all. Thank you.